QB started in 2008. My partner Robert Almgren and I saw a significant opportunity to bring dedicated agency algorithmic execution and solutions to the buy side. And so we started QB in New York with a focus at that stage just on interest rate futures here on CBOT. Our customer base is very diverse now. At the onset around 2010, when we started doing our first trades, it was really CTAs. They gravitated towards us because we spoke a similar language. They were grappling with trying to solve for implementation or slippage across global markets and nearing 40 different exchanges. And we came in with a very specialized approach, starting with one market. As of today, cover all the major North American and European futures markets, as well as expanding our footprint in Asia Pac with ASX and SGX. We've had this concept for some time internally to QB, but through this paper that we're publishing this week, we wanted to share the insights on a concept called regimes. And regimes relates to that of slippage and execution performance. And we used this approach to give advice and counsel back to our customers as to how our models are adapting to this environment and how they should be engineering or thinking about their executions in this heightened volatility market. We're looking at, in real time and also historically, things like volatility, quote size, bid-offer spread, and it's a combination uniquely to each and every instrument, how these interrelate and give us a better estimate of slippage. And we use that insight to then determine whether we should apply a form of scheduling to that of an arrival price execution strategy, which is the most common methodology used today now to execute in futures markets. The concept here is that there is dynamic environments, and so naturally where we're going as an organization and with our offering, you want your models, your execution strategies to adapt to the real-time circumstances. And so naturally, as a regime changes from high volatility to low volatility, or high slippage to low slippage, as we would talk about it or refer to it, then yes, you want your models to adjust to how they're executing in the marketplace. The ramifications of these dynamic shifts and having algorithms dynamically change in how they behave, front-loading, back-loading, etc., is the impact to that of algo wheels. So think of an algo wheel as your decision framework or a database that allows you to decide if I've got five algorithmic broker or five algos that I can use to execute this particular trade of buying 100 tens, which one of these is likely to give me the best slippage, looking at the historical statistics. Look, it is a multivariant approach that we track. So volatility in combination with liquidity, with bid-offer spread, historical intraday patterns, as well as even price trend. Those as a construct form almost an output for us. So our environment is designed around consensus. So another observation that we've seen in this span of the heightened volatility over the last couple of weeks has been slippage is certainly far more significant. But when you actually analyze that, and very importantly, when you analyze that against sweep to fill, which is another quantifiable metric, we're seeing increased outperformance of that. Now, sweep to fill, to translate, is a computation of what a market order would have done at that point of time when you kicked off the order. Now, we see that obviously there's a lot of trading activity going on in the marketplace, but probably an increase in market orders that are moving the book and taking out liquidity. So our key observation has therefore been that if you are trading in this market, you should be using more of a dynamic model and not necessarily going to a market order, because you won't yield consistently the best results.